The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, that if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
There's two kinds of items that people buy and think they're investing. One really is investing and the other isn't. If you buy something, a farm, an apartment house, or an interest in a business, and look to the asset itself to determine whether you've done something, what the farm produces, what the business earns, and so on. You don't really care what the stock market's open. You can do that on a private basis. In fact, you do it on a private basis if you buy a farm or apartment house generally. And it's a perfectly satisfactory investment. You look at the investment itself to deliver the return to you. Now, if you buy something like Bitcoin or some cryptocurrency, you don't have anything that's producing anything. You're just hoping the next guy pays more. And you only feel you'll find the next guy to pay more if he thinks he's going to find somebody that's going to pay more. Now, if you ban trading in farms, you could still buy farms and have a perfectly decent investment. If you ban trading in apartment houses or even in equities, if you ban trading in Berkshire Hathaway for the next 5 years, our investors would do fine, over time. But if you ban trading in tulip bulbs, or if you ban trading in some Bitcoin, which nobody knows exactly what it is, people would say, well, why in the world would I buy it? And you aren't investing when you do that. You're speculating. There's nothing wrong with it. If you want to gamble, somebody else will come along and pay you more money tomorrow. That's one kind of game. That is not investing.
How do you tell the difference between reasonable and unreasonable fear? So in other words, the stock's down, maybe it should be down, or a stock's down, maybe it shouldn't be down.
Well, you just keep looking at the facts. I mean, you're looking at a business. That's the important thing. You don't look at a stock chart. I looked at stock charts for years. I used to have a lot of fun doing that. I was kind of groping around for a philosophy. You look at the business. I mean, how you decide if you own a half interest with somebody of yours in a McDonald's store, how do you decide, whether it's a successful investment? Well, if the snow's 2 feet out and there's no business today, do you say, well, I made a terrible deal? No, you look at how it's performing as a business over time, how it's doing versus the competition. Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about individual businesses we'll do over time, and we compare that to what we have to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic even if the price was right. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses. And it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses, what those numbers tell me. They're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year. We care a lot about the price. We do not care about the next 12 months.
But are you surprised at how long this economy has been expanding?
I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, if you go back and read Keynes or you read Samuelson, you read any of them, they do not get into a negative rate environment. I think now there's still 11 trillion that's of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen, at least the conventional wisdom, a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions.
Warren, what do you consider the most important quality for an investment manager?
It's the temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right. Certainly most of the professional investors focus on what the stock is likely to do in the next year. But the real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. There are all kinds of things I don't know about, and that may be too bad. But why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing.